All right, so good morning all. I'm Shlomo Cooper and we are in the Investors Club. We are just taking 1 hour before the start of US session, before the start of a new exciting trading week, and we just want to make our trading plan for this week to see where all the indices are, where they are all situated, where they are heading to, and to just figure out how to make wise steps and wise calculation in order to have a good to have a good trading week. So last week brought the real start, I think, to June quarter earnings with some high flyers, including we saw Netflix and we saw Google, a breakthrough in the Greek soap opera of the last several weeks, the latest Joe boning from Fed Chair Janet Yellen, and of course some mixed economic data. Even though some of the news drivers of late will cool down, the reality is the news flow will remain fast and furious in the week ahead. With another week in the books, it's time to take a look at what might roll the dice in Wall Street this coming week. So let's just see our table of all the performance across the board of major indices in the US arena. First of all, the S&P 500 is actually gaining some foot here, with up more than 2.4% for the week. This is sharp gains for 1 week, makes it more than 4% year to date. The Nasdaq is leading all the group with more than 5.5%. Of course, Google, Amazon, and Netflix contributed to this amazing sharp gains. And right now, the Nasdaq is with two figures since the start of the year to date, more than 10%. The Russell 2000, we are going to talk about it, is taking the back seat right now with only 1.2% up for the year, for the week, making it just below 6% year to date. The biotech are faring well. It continues to fare well, more than 6% this week only, making it up more than 31% year to date. And we saw the oil, this is the ETF USO, going down again, almost 4%, making it more than 16% down since the start of the year. And the oil is still one of the weakest area, and of course it's contributing to all the red of C. The red we are seeing in the energy, the XLE is down more than 7% year to date, going down more than 1% this week only. Remember Greece, remember what about China? And maybe 2 weeks ago, global investors couldn't get their minds off of these two macro issues, China and Greece, as quickly as they popped up. Though they disappeared once the Greek deal got done earlier last week. Investors quickly moved on and turned to back to earnings, and they focused on massive beats by two consumer tech companies, Google and Netflix, and we're going to see them shortly. And as I said a couple of times in the past, the solution of the Greek problem was a certain thing. The question was what solution is quite irrelevant. Whether Greece would find itself outside of the Eurozone or part of the Eurozone, it's irrelevant for investors. Each solution would have worked perfectly for the US markets and for stocks stocks investors who are looking for certainty and can't hate more the haze of uncertainty. Once this kind of deal was achieved without any connection to its inner qualities and whether it's going to survive or not, the market was able to run higher. Investors, without hesitating, turned their focus in last week back to earnings, where they were able to see NFLX and Google, and let's see them on the chart. It started with NFLX on Thursday, with its going high, surging something like 18% in one day after it just gave investors a great numbers on new subscribers there. Also, we saw Google flying higher, GOOGL. Google went up something like 16% on Friday only, and these are two stocks that we've recommended in the past in our investors club. They both sold to new highs, and of course with such healthy gains, I do hope you are going to the cash register and taking some money off the table, putting money in your pockets. There's no meaning, and there's no meaning, just investing or trading in US markets without feeling the gains in your pockets. We have to understand what we are doing here, and part of it is just, to take profits and to actually feel and smell the money. All right, so let's take a look at the technical setups for majors US equities indices as we head into a new trading week, and we are going to start with the Nasdaq. And even before that, we talked in 2 weeks ago about the 200 moving average that we will see on the S&P 500, and there is a resolution, and we saw here an analysis that tells us what usually what our stand should be towards the 200 moving average on the S&P, for example, when the index is falling to this to this line. Usually the technical analysis is telling investors just to sell and run away, but as we recommended and as we analyzed, we saw that a week after a break below the 200 moving average, and even month after breaking down the moving average, usually we have healthy gains. All right, because it's just a buying opportunity, and we have to stress it. All right, it's not a sell signal by no means, and hopefully you took this. Another thing that we saw 2 weeks ago was July seasonality. We are putting it at the start of each month, and although July started off with great volatility, we know that using the statistical figures, last 100 years or last 50 years or last 20 years, there are July posted on average gains, healthy gains on each of these time windows. So we do have bullish bias when we started July, and we still hold it, and hopefully you are too with us on that. Also, we saw 2 weeks ago here in the Investors Club 5 stocks that in last 5 years, in each of July of last 5 years, they are actually brought investors with gains, healthy gains, and on average Tesoro was top of the list with 8.8% gains at each of the last 5 July. We also saw this slide, slide that showed us Tesoro. Tesoro is in the blue bars against the S&P 500, which is in the orange bars. And although in 2011 or 2014 the S&P 500 was down for July, TSO still went up and went up attractively, was attractively trading higher. And hopefully you took this one, because I took this one, and I know at least from my conversations with traders, I know that couple of you, more than a couple of you, actually quite a bit of traders here took Tesoro, and let's just see what Tesoro made for us in the last 2 weeks since the start of July. So Tesoro didn't disappoint us, and it just lifted off. Since the start of July, it started around $85. Right now, more than 17%. And you know, this is exactly why we are making all of this statistical analysis, because it works. You know, it's just black on white, and you can you can drill down and understand why the fundamentals is working the way it works. And I also explained that 2 weeks ago, but the bottom line never lies. All right, so let's go to the setups of the major indexes. We are going to start with the Nasdaq. So this is this chart of the Nasdaq Composite with huge gains from large cap Nasdaq stocks like Google. Let's just go to the chart. Google that we are seeing right now, or Netflix, NFLX, and even Amazon last week. The Nasdaq has broken out to a new all-time high. This actually reconfirms the index's long-term uptrend and sets the index up for at least the possibility of another nice leg higher. So we still do have a bullish bias, although we can have from time to time a retracement, a pullback like the last pullback we saw here. Any pullback right now back to the 50 daily moving average or the 200 moving average will be a buying opportunity. Right now the uptrend is here, and we don't want to we don't want to go against the major trend. Let's go to the S&P 500, and while the Nasdaq has broken to new all-time highs, the S&P 500 has yet to take out its all-time high reached almost 2 months ago now. For technical bulls to sleep easy at night, we are going to need to see this resistance, the black line here, the overhead resistance, clear break. For now, the index is still stuck in a 5-month sideways that has been extremely tight, and we saw 2 weeks ago that this was actually the smallest range for the S&P 500 so far into the year, 7 months into the year, and the range of the S&P 500 is just something like 7%. At the top of the year, it was up 3.5%. At the bottom of the year, that was in early February, it was down 3.5%. And you don't see, you can't find any example in past history of the market of such a tight range since the start of the year. We also showed you analysis what happens usually in the second half of the year after we have an index or a market that is actually digesting prior gains of prior years, but it doesn't make any advance by its own. And usually we do see the market continue its climb later the year, in the second half of the year, and we are going to talk a little bit about it later in this session. But right now, this is the rising 200 moving average. We saw the analysis earlier, and we can say that buyers succeed in buffering the 200 period exponential moving average. So if last week we spoke about buyers facing off against sellers to buffer against declines at the 200 period exponential moving average, and this is the orange line on my chart. With a trading week now behind us, we can say hands down that the S&P 500 held its ground in a test about which we couldn't have been more unequivocal, having said loud and clear that we've got a buying opportunity on our hands. Again, as called for by a long-term uptrend that has proved itself time and time again, the market is on the verge of hitting a new high. It's just a time when it's going to show us it. The SPY right now will now need to show what it's made of. The Nasdaq already broke up this past week to a new high, and now the SPY will need to follow suit and not let the Nasdaq muscle it out of the game. With every retreat, we anticipate two pockets of demand that are likely to give the market a boost. The first comes from the open gap produced around here at the beginning of last week. Actually, it was a gap and go for all of the week. Shortly we are going to see it in 30 minutes time frame, and you'll see all the gaps, but it's yet to be closed. This gap, the open gap, spans until the 207.48 point level. A breakdown of this level not expected this week, if at all, will signal another test of the 200 period moving average. This is also, the horizontal support around 204. Right now this is the support of July, but it actually a prior support of a double bottom created in mid and towards the end of March this year. This is the major support right now. Let's move to the 30 minutes time frame just to see how the S&P looks on this time frame. This is as I call it, or as I preserve it, this is the long-term chart for day traders, and this is actually Monday. So we kicked off the week here, the week here with a gap and go, and from here we actually the market didn't look behind, and right now we can just place a couple of gaps in recent sessions. First of all, the gap of Thursday, last Thursday, that didn't fill completely. All right, this one, all right, it almost been completed on last Thursday, on the 9th of July, but it's not completed, closed. Then we had another gap and go on last Friday, all right, 2 weeks ago, another gap up on Monday, and just look how many voids the market just leaves behind it, and maybe at some point of time it will move back to fill these gaps, but right now we look on these voids that haven't been filled yet as pockets of demands. All right, this just gives you a sense of what is the determination of the buyers right now in the market. And here we see another gap and go on Thursday that hasn't been filled yet. So lots of gaps, and this is just how the buyers are very, very assured at their plays. All right, let's move to the Russell 2000, and these are the small caps. This is the Russell 2000, and with the Russell 2000 small cap index outperformed in the first half, we remember that it has underperformed over the last few weeks. Large caps have been the leaders lately, as evidenced in what we saw in the performance table of all the major indexes. The Russell has yet to break out. Let's put it again on the slide right now. This is the Russell 2000. All right, so it has still a space till it's going to test prior highs it reached a couple of weeks ago. But from a technical perspective, it doesn't look bad either. We could see it test its 50 days moving average. This is the black line on my chart this week, and at that point we will have more evidence as of if the buyers step in or not. Let's take a quick look on the VIX. Just 2 weeks ago, the VIX volatility, the VIX is the fear index, or if you want, the volatility index. It spiked up towards the 20 due to Greek debt fears. Here, so this is the chart of the VIX, and once the Greek deal got down, investors breathed a sigh of relief, and the rush to get back in was on. Who would have thunk it at the start of a new week? The VIX fear rush has been completely wiped out, and it's actually now hitting its lowest level of the year. So this is actually absolutely a sign of confidence of the market. We spoke a little bit about the Nasdaq. We mentioned the Nasdaq composites break to new all-time highs. So, but I wanted to show you a long-term chart of the Nasdaq so you can see just how impressive the current run has been. So we can see here the Nasdaq composite since 1996, even before the run, the pump of the dot-com bubble, and we actually see here two tops. This is the top. This is the top of the dot-com bubble. By the way, this is the top of the. This is the top of the housing bubble in October 2007, and if you put here a chart of the Nasdaq, you would have seen actually the S&P did something like this, and on the S&P 500 we had something like this. We had actually a double top, but the technology index wasn't strong enough to get back to prior highs, and right now it's actually breaking through prior highs through the dot-com bubble. So back in the mid 2000, I remember a lot of investors said the Nasdaq would never see its highs from the dot-com bubble again, but the prediction has now been proven wrong. This same the same prognosis is right now saying that the current rally can't last. Now, the chart of the Nasdaq right now definitely looks a little bit scary, and at some point we are going to experience another significant pullback, but as I've pointed out a number of times here in the Investors Club, age and percentage gains are just not reasons for bull markets to come to an end. You just need to have a very deep and very fundamental look on the economy in order to understand when the next major downtrend is going to show itself, and right now we don't see anything like that on the economic horizon. All right. Back in 2013, the Nasdaq Internet Index was soaring at the same rate as the biotech index, and let's just put it on the chart. So I'll get back to the daily chart here on Cormex. All right, so this is the daily chart, and we know that, and we all know that the biotech, this is the IBB, all right, the ETF that you can also trade it, and I'll put it on the weekly chart. All right, so we will have a good look, a good understanding of what the IBB, the biotech index made in the last couple of years, and it's just a linear line, just go in one direction, up and up and up, and every time you think this is the ceiling, this is the top, the index will never go higher. It's just breaking through to a new all-time high, and till mid 2013, it was the same for the internet index. And for the internet index, I'm using in Colmex the ETF called FDN, and you can actually trade FDN. And FDN made the same as the biotech did till even, the early 2014. But since then, since 2014, it just went sideways for the last 18 months or so. But, last week, equipped with the sharp gains in Amazon, in Netflix, in Google, actually we saw it breaking through from its sideways range. So it's worth pointing out that last week we are finally seeing the internet index break out to new highs again. So just keep the FDN. I'll just write it down in the chart. This is something that you can even day trade on a daily basis. Now, one of so this is what we saw since the bottom of July. Just look from 66 to 72. This is a great sharp movement for the FDN, the internet index. Now, one of the major drivers of the FDN, the internet index upwards, is not other than Google, GOOGL, and this was the big reason for the jump in the internet group last week. To say that it has been a good week for Google is an understatement. I have to confess, a couple of months ago we took Google here in the Investors Club. We analyzed it and discussed why the stock of probably the most popular company in the world, much more than anyone else, why the most desired company to work for in the world today, and a company which its brand is automatically being connected to themes like success, innovation, and leadership, a company which has more fans in the world than any other company on earth, and its stock is just doing nothing for the last couple of months, actually since the start of 2014. And one of the reasons we mentioned a couple of months ago here in the Investors Club was the fact it doesn't obey to Wall Street rules. Google doesn't obey to Wall Street rules, so it doesn't dancing to the rules. So Google took Ruth Porat on she's one of the financial stars today in Wall Street. She worked for Morgan Stanley, and so right now Ruth Porat is the new CFO of Google, and she makes they brought her to make order in the mess. So the investors already like that, and a stock that I call it dead money. All right, so Google has done just nothing for the last couple of months. Actually lifted off amazingly in the last week. That brings us to reflect what is investment, because for us right now, we took Google around $530 per share a couple of months ago, and just in the past week, Google made gave us the whole percentage, gave us the all gains, something like 30% right now, and just see how the stock started gaining momentum prior to its earnings on Friday. So it brings us to reflect what is an investment and what should we as investors should expect from any investment. If you think for example, an investment you took can make for you something like 50% over time, that can certainly may happen if your analysis is correct, but markets will never tell you when you are going to be delivered with the goods and at what pace. Actually, we have to understand that most of the stocks are spending less than 10% of their time running to new highs, and most of the time, which is more than 90% of the time, stocks are just doing nothing. They are just digesting and being traded in a predefined range. So this is why patience is a must-have ingredient for any investor, and many times you are sitting on an investment that is just doing nothing and you get all the gains in literally 1 week, and this is exactly what happened for us in Google, and you never know when it's going to come. Now, I, for example, heard two of our investors in the Investors Club, they took together with me and with much more of you these investments in Google a couple of months ago when it was traded for $530. They sold it for a very small profit at the beginning of last week, just before the beginning of the earning week for Google, just to see, the stock makes dozens of percents on their expense without them on this ride. So too bad for them, but this is exactly, I think, the difference, one of the major differences between investment and trading. Trading, you actually don't have time. You have a very tight stop, and you tell the stock, show me gains right now, deliver me the goods right now, or you are going to get fired from my portfolio because you are a lousy worker. All right, and this is a different approach when it comes to investments, where we put more patience to our stock picks. So back to Google. After being dead money for the better part of 18 months, the stock has lit fire and taken off. The culmination came on Thursday after the close, when the company reported stronger than expected earnings. And what was already a great week, we see it here on the chart with the pickup in the volume, actually turned into an absolutely phenomenal one, as the shares of Google jumped something like $90. It's about equivalent to 15% on the news. Since Thursday's close, the company's market cap has increased by more than $60 billion. Now, just to put that in perspective, to understand what is $60 billion overnight, and these are figures no normal human being can even understand or try to sense what is this vast amount. There are more than 400 companies, guys, more than 400 companies in the S&P 500 that have market caps smaller than the market cap Google has only added overnight, over the night of Thursday. Now, the next chart we are going to see, all right, this is the bar chart. The bar chart shows the market cap of each individual stock in the S&P 500. Apple and Google's combined market cap is now just under $1.2 trillion, or equivalent to the combined market cap of the smallest 147 stocks in the index. Just talk about market cap inequality. All right, so from that, and this is this is just amazing me time after time, but good job for us for being in Google, and from Google to the US dollar, and we've been, on top of movements in the US dollar index all year. We first noted that the dollar's uptrend break in the end of April, and we were spot on with what ended up being a key turning point for the currency in mid-May. Since the start of the second half of the year, the US dollar index has moved higher. And by the way, if you'd like to see that on your chart, just put UUP. This is the ETF that tracks the US dollar, and you can actually trade it. But in a minute, I'll show you a couple of, what I think are short or long opportunities for taking stocks on the basis of our perspective on the dollar. And this is why the analysis of the dollar, of the US dollar, is very, very important for us. So since the start of the second half of the year, the US dollar index has moved higher, as we can see, and over the last few days it has broken above the top of its downtrend channel. This has caused a shift back into what we call domestic companies. Domestic companies are just the companies in Wall Street that generate the bulk of their revenues inside the US, and actually investors went out of what we call international companies. International companies are companies that are being traded in Wall Street, which generate 50% plus of their revenues outside of the US. All right, so as shown here in this chart right now, since July began, the average Russell 1000 stocks, this is the bar under all stocks. The Russell 1000 it's just taking the S&P the biggest 1000 stocks in Wall Street by market cap. All right, and the average stock since the start of the July is up 0.71%. Now, when you break it down to those domestic companies and international companies, you see that the average Russell 1000 stock that generates all of its revenues domestically is up 1.85%. All right, so they are gaining from the momentum of the dollar because they are selling inside US, so their revenues is in US dollar. And shortly we are going to see exactly what stocks we are talking about. But for example, the restaurants and all the consumer discretionary, like Disney, like other companies that makes their business only in the United States. Conversely, the average Russell 1000 stock that generates 50% plus of its revenues internationally is down 0.89%. And again, this is because most of their expenses are in US dollar, are in very expensive US dollar, as long as the dollar is going upwards, and their revenues, or most of their revenues, are in euros, which is much weaker than the US dollar. For example, just think of international companies like Caterpillar, Triple M, Alcoa. Let's say think about even McDonald's for part of it. Let's think about Procter and Gamble, Colgate, CL, General Electric. All right, all of the major companies in the US that are international companies, and they are selling all over the world. Now, clearly, we've seen a shift out of internationals and into domestics as the dollar has gained steam in the second half. Now that the dollar's downtrend is broken, as we can see right now on the chart, a continuation of its rally will result in more outperformance from the domestic stocks and underperformance from international stocks. So which are the domestic stocks, which are the international stocks, and what is our bet? How can actually we play it? So here we are going to just take our analysis with a drill down to take an investment opportunity out of the dollar movement, just taking advantage of what we expect the dollar to do, which is to strength. So in this list, in the first list, all right, we have the large cap names with heavy domestic exposure that have the most bullish stock score rating, and I'll tell you what is this stock score rating in a moment. These are potential, all of these stocks in the list, these are all potential long opportunities in a strong dollar environment. Now, the second table, and you can just, if you want, capture the screen to see that. Also, it's we are going to upload it to YouTube later, so you can grab it from there later. This is the second list. The second table is a list of large cap names with heavy international exposure that have the most bearish stock score ratings, as we can see here. The stock score is just going from 0 to 100, so as long as you have, as you are closer to 100 is better, and as long as you are closer to 0, it's for the worst. These are potential short opportunities, or at least names to stay away from in a strong dollar environment. Now, the stock score is built on a weighted average of 3 parameters, taking into consideration fundamental strength, technical strength, and breadth measure. That means that if you are going to see DRI, which is Darden Restaurant, which is and the restaurant industry is, a major industry that is going to benefit from a stronger dollar. Let's take a look on DRI on the chart. All right, and just look, what a beautiful uptrend. Actually, it seems this uptrend is not stopping for DRI since last July. Now, if you remember, last July was the bottom for the US dollar. Since then, the dollar actually started to lift off. And let's just put here on the same scope the UUP. All right, this is again the ETF that tracks the US dollar, and just look how July was a turning point for the dollar. Since July, this is the point where this is the point of time we can say the dollar started to gain steam. All right, and started a sharp wave upwards. All right, and since the start of July, DRI went up sharply. All right, so this is a very, very defined dollar play. Let's take another stock, and since they all have a very good score here, more than 70, they are all going to be they are all going to look very, very good on the chart. Let's take, for example, Reynolds America, all right, the tobacco firm, RAI. I think that was one of our stock pick last week in TradeNet's report. All right, so this is Reynolds American, and again, the turning point here was a little bit later after July. Actually started around early August, but since then, all right, it went hand in hand together with the rise in the dollar. All right, what a nice uptrend. Now, if we are going to see the short opportunities, just take a look on SanDisk. All right, SanDisk, SNDK. All right, SNDK gets a stock score of under 39. Looks, like my nightmares on the chart. This is SNDK. All right, can't stop moving lower as it seems. And if you believe UUP is going upwards, and SanDisk is not only selling its products, flash memories, in the United States, but but across the globe. So it's getting lots of euros from selling it products in Europe and all over the world. All right. So if we are going to see the UUP, the dollar index, coming back to prior highs achieved in mid-March, then you can bet SanDisk is going to have another pressure on the price stock downwards, and that means you can maybe just wait for SanDisk to climb back, to, let's say, the declining 50 moving average. This is the green line on my chart, and as you can see, the declining 50 moving average are actually opposed to served as a resistance for the stock around late May, and it may very much make the same role, play the same role when the price will get back there again. So all right, so I would just use the moving average as a key turning point for the stock after a correction, after a little retracement, and this is how I would play these all stocks. So you can just take just capture it and put it in your computer and keep it. All right. Let's talk a little bit about earnings, and without a doubt, large cap stocks have been strong so far in July, and this has been the case in reaction to earnings as well. Actually, the average S&P 500 stock that has reported this season has actually gained 0.9% on its earnings reaction day. The average non-S&P 500 stock that has reported has actually averaged a decline of more than 1% on its reaction day. So that is, a big disparity, and you remember what we've just seen on NFLX, what it made on its reaction day for the earning, and the same thing for Google. So investors have been willing to own large caps post earnings, but they have been selling small caps names. Now, this is the list of the stocks that have had the biggest upside responses to earnings so far this season. All right, from ANFI, here's NFLX, here's Google. All right, and going down the list, and we here we just mentioned each stock that it's also a member of the S&P 500, and as you can see clearly, actually typically you don't see nearly as many S&P 500 names on this list as we can see right now. All right, so we will talk about how the market is looking right now and what the market should do, or how we see the market in the second half of the year doing. But before that, let's take a couple of moments for the question of the week, and we invite you to send us a question, regarding your trading, regarding your investments, regarding subjects you want us to talk about in the Investors Club, or any other question you have. And we get all of these emails. We're happy to get them. We answer them, and from time to time, if we find a special question that we think that is actual and we think it's relevant to the wide community of our traders, of our investors, we're also happy to bring it up in the Investors Club. And this is the question of the week. And this week we got a question about Garmin, the GPS device. Can Garmin, its symbol is GRMN, can Garmin actually survive? So let's just understand what is happening on the chart of GRMN. And as we can see, there is a lot of pain on the chart, a very, very defined and very, very clear downtrend since the start of the year. Actually, it started much earlier, started in mid-2014. And can you remember when your Garmin GPS was your best friend on the road? it's most likely since being replaced by your smartphone and by the most popular navigation application, which is Waze. And that is one of the problems facing Garmin. So shares of the maker of navigation devices have been suffering as the company struggles to remain relevant as smartphones eat away at the need for dedicated equipment. Garmin's shares have fallen by more than 20% over the past 12 months and more than 10% this year alone. And the pain also continued on Thursday, although we can see here, a green bar. It just means the close was higher than the open, but still the close was sharply below the closure of Wednesday trading day, and here we see the investors reacting to Garmin's lowered guidance for second quarter revenue, and right now the company expects revenue of as little as $770 million during the quarter. This is short of what analysts were expecting. Also, the company took down guidance for quarterly profit to as low as 2.65% a share. This is down from the previously expected $3.10. So investors right now need to see if the company can cook up new products that can take on competitors that increasingly eat away share. Now, the company's fitness tracking segment is under attack by rivals like Fitbit and Apple Watch, and we talked about Fitbit couple of times in the Investors Club, and just look what Fit made since its debut. It debuted around right here around I don't have here the tooltip. All right, just last month, all right, it appeared on Wall Street. This was a great IPO, and since $30, right now it's at $46, and it just can't stop, keep rallying. So actually, Garmin has some problems, some major and serious problems. Analysts rate shares a hold. Let's put back Garmin on the chart. Profit in 2016 is expected to be $3.07 a share in 2016, which is 1% below 2014 profit. Still, analysts think this stock could be worth $48.23 a share in the next 18 months. This is about a 12% up from current levels, maybe back to the declining 200 moving average. This is about where the analyst consensus towards the stock price is right now. Not a lot, and again, this is a sell, maybe even to take it for short play if we can see some kind of a retracement back from a very sharp selling territory. Okay, about a quarter of S&P 500 this week. And let's talk about this week. What's going to happen this week in Wall Street? All right. Okay, so about a quarter of S&P 500 companies report earnings in the coming week. This is going to be a very special week. So, finally, we can be positive about putting all the worries about Greece and China in the background. So far, just several dozen companies have reported, and the actual 70% plus beat on the top line, while just about half beat on revenue. Among the names reporting this week, we can find Apple and Amazon and IBM and American Express, General Motors, Boeing, Coca-Cola, Amazon. So a lot of major American firms. The reaction to earnings has been relatively good. We saw it especially on NFLX and Google last week. Coming into this earning reporting period, analyst sentiment was actually something somehow negative. We were getting more downward revisions than upward revisions, and typically when you see that coming into a reporting period, the market performance is much better than when you see analysts upping their estimates. So, this is a good environment where the bar is placed so low. It's easier for American companies to just deliver good numbers, good figures. The stock market should not fear a small rate hike from the current zero level. I think the Fed is dying to get started already, and they should. My guess is they probably go in September, or or maximum in December, but they are going to press on the rate hike this year, just to make the move. They want to make the move already, and the question is not the first rate hike. The question is how much and at what pace. These are the real questions. Now, what matters to the market most is always the economy and the earnings. We kind of got away from that because we focused on the Fed and Greece and China. Earnings are coming out and they are right now okay. I think they will at least meet and probably exceed expectations. I think that with the disappointments in the first quarter due to falling oil prices and the rising dollar and economic weakness, the cuts were overdone, and therefore I think the estimates are way too low. So that means most of the firms in the United States will be able to exceed expectations. They are going to deliver, and that means investors are going to be happy. We are going to be happy. We are going to see the market going up more higher, and that means although the Nasdaq is already in 2 digits gains since the start of the year, we are saying it here that the Nasdaq 100, if you are just coming into the investors club right now, is more than 10% year to date. I think it's going to make another leg up. I expect the consumer to help generate gains for stocks in the second half of the year as the benefits from lower oil, and again we saw the USO, the ETF that tracked the oil, coming down last week almost 4%. So the consumer is benefiting on that aspect, and finally the lower oil should finally kick in for the consumer. The conditions for a good second half is better visibility on earnings. I think we will get it. I think it comes from the consumer. If I'm wrong, then I think it's 2 steps forward and 1 step back. Keep your eye on wage growth. If we get some wage increases, I think it's more good news for the consumer. I think that all the concerns that corporate margins would suffer if wage growth picks up, this is nothing, this is nothing to be concerned about. Margins start to struggle, and earnings do too when wage growth gets to around 4%, and we are way from that. I expect the economy to strengthen as the year goes on. I think stocks are pretty interesting compared to other places. You can put your money there. The S&P 500's yield is not all that different than the 10-year Treasury. It's 2.15% for the S&P and 2.35% for the 10-year Treasury. So actually, I could see the market at least doubling its current 2015 gains of about 4% by year end, and probably by the end of 2015 the S&P 500 is going to sit on gains of between 6 to 10%. Alright guys, so we are coming to the end of the Investors Club. Thank you very much for being here with me for the last 1+ hours. Hopefully this is useful information. Hopefully you are getting here a good information that it's making you or giving you the tools to make better decisions and investment ideas for this current week and next weeks. As always, we are going to see each other next week. I wish each and everyone here a very, very successful week. Absolutely, it's going to be very interesting with Apple, with IBM, with Amazon, lots of earnings. So this is what we are going to focus in. Thank you very much, and Scott is going to be with us shortly. Have a good week.